As a certified financial planner specializing in cross-border investments for NRIs, I have discovered something that contradicts all the financial wisdom. A common question that I get asked a lot is, Alok, does it make sense to invest in Indian markets as US markets gives better return and rupee also depreciates? Now, despite what most of the NRIs think or hear, keeping 100% of your investments in US markets might not be optimal for you. My analysis of back-tested market data reveals a specific split of US and Indian investment ratios has generated consistently superior returns for you. Today I am sharing this professional insight that most people miss because they lack expertise in both the markets. Before I dive into sharing my screen where I'll show you the exact numbers, let's talk about why investing exclusively in one market, even if the powerful market like US markets, might be a limiting option to your potential returns. The first is, when you invest in just one market, you are exposing yourself to that country's specific risks. So think about it, like economic policies, political events, and even natural disaster in a single country can significantly impact your entire portfolio. We saw this during 2008 financial crisis, which hit US investments particularly hard, and more recently during the pandemic recovery period also. Secondly, you're missing out on the growth opportunities in other markets around the world. While the US market has certainly performed well historically, there are other dynamic economies that offer tremendous growth potentials and that could also complement your US investments. And finally, and perhaps the most important thing for NRI, is that you are overlooking the natural hedge that comes along with investing into multiple currencies. So your growth of the entire wealth doesn't actually depend only on one single currency. It is diversified across globally and different currencies and markets too. So this brings us to a big question. Is there a better investment strategy for NRIs globally who are investing into US market rather than putting 100% of their money into US markets? To answer this question, definitely I have conducted extensive backtesting using historical market data. I wanted to see if there's an optimal investment allocation that consistently outperforms a US only portfolio for NRIs as opposed to a normal one. Now I'm going to share my screen and walk you through what I found. We'll look at the historical performance of a 100% US based portfolio and compare that with alternate strategies that might come along with other geography. And when I mean other geography, I specifically mean India, because since you are an NRI, you have the liberty to easily invest in Indian markets. So let's jump to the screen. So this is a tool that me and my research team uses when we are backtesting many portfolios and analyzing how any of our clients' portfolio needs to be restructured. And I'll just do simple operations to show you what I'm talking about. So I want to start with, let's take an example wherein the 100% money is invested into US markets. So somebody who is an investor into US markets would rather invest into a Vanguard 500 kind of an ETF or an index fund to get exposure into the entire market. So as you can see here on the screen, we have the first portfolio which has 100% allocation into Vanguard 500 index. Now if I save this portfolio and show you what the returns has been, you will see that this portfolio has given somewhere around 7 or 8% return since inception. Now one more thing which I want to show you is what is the time horizon that we take to compare these investments, right? Right now the default setting here that we have is from 2000, but let me take like a very realistic 20 years window for you. So let's do one thing. Let's go back exactly 20 years from now. So let's say 2003 is where we start investing. So the example that we are taking here is somebody who would have invested $10,000 and exactly 20 years back till the end of 2024. In this case, if you see, the returns are slightly higher. Why? Because from 2000, if you measure things, that is when the dot-com crash happened, and that is the reason you might see slightly lesser returns. But let's say somebody who moved from India to US and started investing in 2003 and invested 100% of his money into US markets, you will see that they would have made somewhere around 11% return. So a $10,000 invested in US markets will become almost 100,000 in a time span of 20 years, somewhere around 20 years. And the net return made is 11%. Now, this software only shows us dollar returns. So whatever I'm going to show you next will always be adjusted for all the rupee depreciation and everything. Now, as I mentioned, is there a better way for you to invest rather than investing 100% into US markets? So what I'll do is I'll quickly go to the portfolio section and then I'll add a second portfolio. Now this second portfolio for an NRI who wants to invest in India would typically invest in an Indian index or an ETF fund. let's say Nifty 50, right? So the oldest ETF that right now exists in Indian market is Nifty Bees. So I type here Nifty Bees, which is by Nippon Mutual Fund. This is mainly investing into the Nifty 50 stocks. And let's try out something. Let's say somebody would have, rather than investing 100% money into US, invested 50 in US markets and the remaining 50% money in Indian markets. What happens in that situation? In the same situation, adjusting for all rupee depreciation and everything, the first 100% US portfolio gives you 11% return, but the second portfolio also gives you 11% return. What you will realize here is that if you invest 100% money into US or you diversify 50-50, you end up making same returns. So one might ask, right, does it make sense for me to diversify? But my answer will be yes. If you are eventually going to get the same returns, it will make sense for you to diversify and then have both the country's currency risk eliminated rather than putting everything into one basket. And if the returns are going to be same, then why not do that? It might be slightly higher, but then I think that is negligible. So if you see both situations, the returns are 11% and your $10,000 ends up becoming $100,000. Now let's take a third scenario also. For example, in the same portfolio, the US S&P 500 and the Nifty 50, I do a 70-30 split. That means 70% of the money stays in US and the 30% is invested into India. So what would have happened with this kind of an investor, right? If I analyze the portfolio and show you, portfolio 3 has given 11.4% return. That is 0.4% more than the first 100% US portfolio and the second 50-50 India US portfolio, right? This 0.4 might look very small amount, but if you compound it over 20 years, the amount ends up becoming slightly bigger. So if you see, portfolio 1, $10,000 becomes 100,000, same in portfolio 2, but the 70-30 portfolio grew from 10,000 to 107,000. This means you have almost gained excess money to whatever principal you had invested, right? And this is really good return. If you see, the standard deviation is also under control. The maximum drawdown this portfolio had was also very much controlled. So there are certain technical things that I don't want to bore you with. So what we understand from this example is, instead of investing into 100% US markets, if you split your investment 70-30, you end up making higher returns. And if you end up investing 50-50, you might make same returns, but at the same time, your money stays diversified. So you don't bother much about what's happening in your specific country. Are they going to war or things like tariff, which is happening right now, right? And also, one last thing which is very fascinating, which you must see, is the dollar, the rupee actually has depreciated a lot since COVID time, right? Because US has actually printed a lot of money, which has gone into the markets and which has actually boosted US returns. But there's something very peculiar about this example that I want to show you. If you see this graph that I'm showing on the screen, the blue line, which is your portfolio 1, the green line is portfolio 2, which is 50-50 portfolio, and the gray line is portfolio 3, which is the 70-30 portfolio. So if one thing which you'll notice about this graph is, till 2019, that is till pre-COVID era, the 50-50 portfolio actually gave you higher returns. And I'll also show you the numbers quickly. But just if you can see from this graph, the 50-50 portfolio has done way better than the other two portfolios till 2019. What happened post 2019? COVID happened, US printed a lot of money, which went into the markets. And that is why we are very skeptical about anybody putting 100% of their money into US markets, because things might not be the same how they were in last few years, right? So let me do one thing. What I'll do is, if I go to the settings, change settings here, and I take the date as 2019 and analyze the same three scenarios. If you see in this case, annualized return of 100% US market is 10%. The portfolio 2 is 9.87 and 3 is 10.38, right? So if you see, the 50-50 portfolio has actually outperformed the other two portfolios, right? So pre-COVID, it would have made sense for you to invest half of your money into US and the remaining half into India. Post-COVID, a 70-30 split would have worked better for you. But going ahead, maybe 70-30 might not be the best thing for you. Maybe again going back to a 50-50 portfolio, or a India 70 or a US 30 might make more sense because of all the geopolitical thing and dollar devaluation which is about to be expected, and the recessionary environment that is happening currently in US. So I don't want to give any advices in this video. The only thing that I wanted to convey is, the first doubt that I wanted to eliminate is, does it make sense for investing in India? Absolutely yes. If you diversify your portfolio 50-50 or 70-30, you still end up making same returns what you would have got in US markets, in some cases slightly higher also. Now let me break down whatever I showed you exactly and summarize things for you. First is, if you're investing into a diversified way, you are actually betting on the non-correlation between two countries, and you are exposing yourself to different cycles, which actually helps your portfolio hedge against any kind of financial risk. Secondly, you are benefiting from currency diversification also. So for NRIs who have financial responsibilities in both countries, perhaps supporting their family in India, or maybe let's say they are planning a potential return back to India, it's better to keep a natural hedge between the currency fluctuations of both countries. And third, if you are positioning yourself to capture India's phenomenal growth potential, which India is projected to be because it's about to become the world's third largest economy within the next coming decades, right? So with this rapid expanding middle class, you would actually want to participate in India's growth story as compared to any developed country. So definitely you should have some significant allocation into Indian markets. And as I wrap up, I want to emphasize that India and US diversification isn't just about maximizing returns. The main thing that I always focused upon is risk management for my clients. And this is what our advice has been to everybody who works with us. So I hope you like this video. If you want more insights about some stock to stock comparison, or if you want me to compare different markets other than US markets, please let me know in the comment, and I would want to make more and more such videos and show you exactly what process we follow on the back end as advisors. So I hope you like the video. Join my NRI only WhatsApp community, for which the link is in the description below, and I'll see you in the next video. Thank you.